What's up, boys and girls? Chris Nelson here, bringing you another Just the Tip Tuesday. And this week, I want to talk a little bit about what you, as a buyer, should not do if you are either under contract or soon to be under contract. Over the years, I have lost quite a few deals because either I didn't educate my client on these things or they simply didn't listen to what they were being told. But before we get started, a little bit of house cleaning. This channel is all about real estate advice, tips, and tech. So if any of that excites you, you're in the right place. But do me a favor, consider giving me a thumbs up, drop me a comment, subscribe, and mash that bell so that you're notified of my future content. Now, if you're under contract or just recently pre-approved to buy a property, the first thing you want to avoid doing is making any large purchases on your credit cards. As a matter of fact, you should try to live life as you normally have up until this point. As we discussed in one of my previous videos about credit, and if you haven't seen that video, I'll go ahead and link it in one of these corners. But one thing that we spoke about was your debt to income ratio and how that can impact your credit. So just because you are approved now, you need to realize that your lender is going to pull your credit again before settlement. And large purchases on your credit cards can greatly change your debt to income ratio, putting you in a position where you no longer can afford the property on paper. Large purchases could be anything from transferring debt from one credit card to another, or even buying new furniture for the house that you think you're going to be buying. At the end of the day, make sure you are not making any large purchases on your credit cards. Speaking of credit cards, the second thing you want to do is to avoid opening any new credit cards. What people don't realize is that initially when you open a new credit card, although over the life or the term of that relationship, it should improve your credit so long as you're maintaining those payments. But when you originally apply for a credit card, it can actually drop your credit score. As a matter of fact, I've seen credit scores take a hit of 15 points or more just because they applied for a credit card. So don't apply for credit cards, and at the same time, don't close out any credit cards that you have. Again, credit is based on relationships and longevity of those relationships. So by closing out a credit card, even if the terms may not be as attractive to you as they were when you got the credit card, it still makes sense to make sure that you're keeping that account current and open at least until you settle on the property. So don't go and open any new accounts, and be sure not to close any of the accounts that you have. This also applies to things such as cars. Do not refinance your car or any large debt that you have during this time. Even if it drops your monthly payment, keep in mind that we're not talking necessarily about solely the debt to income ratio, but we're talking about your debt to income ratio in combination with your overall credit standing. Another thing you want to avoid is making purchases that require your credit use. And one of the biggest things that comes to mind is furniture. I can't tell you how many times I've had a client call me and they say that they're looking at furniture and they're thinking about buying a new living room set and a dining room set, yet they haven't even made settlement on the home. But their mindset is that they want to be prepared when they move into this home and have this furniture. And a lot of times it results in putting in an application for credit with some of these furniture stores. And once that application goes in and hits your credit, bringing your credit score down, guess what? You may not have a home to move that furniture to. And the very last thing that I suggest that you avoid doing is making any large and odd deposits. Your checking account and a majority of your accounts are going to be looked at by the lender. And due to the Patriot Act and a few other moving mechanics, large deposits definitely put you in a bad position if they cannot be justified and explained. So for example, if mom and dad are giving you a gift and that's a large deposit, well, that's a little bit different because mom and dad can also show you that the money came from their account and they can give you what is referred to as a gift letter. These are things that are acceptable because the lender can justify where this money came from. However, if you have mattress money, and although that may sound funny, you'll be surprised how many people have several $1,000s that are just tucked into somewhere in their home, not in a bank, but yet because they know they need this money to move forward with the purchase, they go ahead and put the money in their account without being able to show a paper trail on where that money came from. And I can guarantee you that once your loan goes into underwriting, that underwriter is going to look at that and pick it up. And if you can't justify where that money came from and show that paper trail, well, you may have just cost yourself a transaction. So there you have it, folks. This week's video is short and to the point, but hopefully these few tips will keep you on track and keep you from losing a transaction. And with all of that being said, I look forward to seeing you all next week for a very next episode of Just the Tip Tuesday. Take care.